Welcome to Talk Tickers, your go-to source for breaking down the latest earnings calls.
Glad to be here.
Today, we're diving into Lands' End's second quarter 2025 results. Now, this was an after-hours call, and the market reacted with a noticeable degree of caution.
That's right. We'll explore the reported numbers, sure, but also management's strategic insights and, the updated guidance.
Exactly, helping you understand the full picture behind that initial market sentiment.
Yeah, because you'll hear about some key operational wins alongside, frankly, the top-line pressures that seem to worry people.
Okay, let's quickly recap the headline figures for Lands' End's second quarter. The stuff everyone saw first.
The main numbers, yep.
The company reported an adjusted EPS of -6 cents. That actually missed consensus estimates by 3 cents.
And the GAAP EPS.
That came in lower at -12 cents per share.
Okay.
And on the top line, revenue was $294.1 million. That fell short of consensus by about $28.3 million.
Oof, that's a decent miss.
And it marks a 7.3% decrease year over year. So you can see why the market might pause.
Absolutely.
Yeah.
While that revenue miss and the wider loss certainly gave the market pause, there were some notable operational positives under the hood.
Like what?
Well, for instance, gross margin expanded to approximately 48.8%.
Really? Despite lower revenue?
Yep, an improvement of about 90 basis points year over year. That's nearly a full percentage point better margin on what they sold.
Okay, that's interesting.
Adjusted EBITDA stood at $14 million. Now, that was an 18% decrease year over year, so that reflects some pressure.
Sure.
But importantly, the company reduced its inventory for the 9th consecutive quarter, down 3% year over year. That shows some real disciplined management.
9th quarter in a row on inventory. That's quite a streak.
It is. And they also repurchased $1.7 million in shares during the quarter. They still have $8.8 million left under their authorization, too.
Signaling some confidence then. Okay, let's unpack this a bit. Beyond those headline numbers, what were the core themes management really emphasized during the call? What story were they trying to tell?
Management really focused on a strategic pivot. That was the main narrative.
A pivot how?
Well, they highlighted a continued mix shift towards higher margin categories. Makes sense, right? Sell more profitable stuff.
Right.
And disciplined SG&A management. Selling, general, and admin expenses actually decreased by $6.1 million year over year in Q2. That's significant.
Okay, cutting costs.
And a big one, significant progress in developing these asset-light distribution and marketplace channels. It's a clear roadmap they're trying to execute. Less reliance on their own stores and direct website, maybe.
Okay, here's where it gets really interesting for me. Let's delve into how these strategies are actually playing out across their business segments and, how they're impacting the financials.
Right, let's get specific. First up, this distributed commerce model they talked about. The CEO described increased momentum across the business, particularly in their B2C segment, business to consumer.
How so?
They're seeing strong engagement through licensing and third-party marketplaces like Amazon, Nordstrom, places like that.
Ah, so selling through other companies.
Exactly.
Yeah.
And get this, those channels are attracting over half of their new customers.
Half? Wow.
With virtually no capital investment from Lands' End side. Licensing revenue, for example, grew 19% year over year.
19%?
And in the Q&A, the CEO even noted a 36% rise in licensing revenues when discussing some specific details. That really stood out.
That's huge growth compared to the overall revenue decline. What's driving that?
Well, a key initiative here is the new Lands' End Essentials line, launched on Amazon. It features about 40 styles.
Essentials, like basics.
Yeah, and it's strategically priced as an entry point. The idea is to draw new customers in via Amazon.
And then hopefully get them to explore the full assortment on the main Lands' End site.
You got it. Using Amazon as a customer acquisition tool, basically.
Clever. Okay, what about their traditional B2B business, the Outfitters segment?
That segment had, and I quote, a terrific quarter. Growth in both top and bottom line there.
Oh, really? What drove that?
They reported significant contract extensions in the travel and banking sectors. Apparently, it's their highest growth in contract duration since the company spun out way back in 2014.
That's strong validation for their B2B offering.
Definitely. And the school uniform business also saw high single-digit growth, fueled by new customer wins. They even mentioned their OCATE certified product helps there.
OCATE.
Yeah, it's about environmental and social standards in textiles. Gives them an edge, they said.
Interesting. Any hints about future B2B growth?
Management did hint at building out new adjacent categories. They specifically mentioned the healthcare industry as a focus area, leveraging their existing B2B know-how.
Okay, so B2B is strong, B2C is shifting to marketplaces. How does this all tie back to margin expansion and cost discipline? You mentioned margins improved earlier.
Right. Despite those initial tariff headwinds everyone was worried about, gross margin rates improved year over year by those 90 basis points.
How'd they manage that with tariffs?
They've actively repositioned their sourcing network, apparently, and are working closely with vendors to mitigate those tariff impacts.
So, supply chain adjustments.
Exactly. And while some costs are inevitably being passed to customers, the company aims to minimize this impact. They talked about splitting the burden between internal changes and small price adjustments.
The balancing act.
Very much so. This focus on operational efficiency is really key to their profitability goals, especially when the top line is pressured.
Makes sense. But are people still buying the actual product? What about product innovation and customer engagement?
Good question. Their weather-proofed assortment strategy seems to be yielding results. It allows them to sell wear-now items more effectively, adapting to changing weather patterns and shopping habits.
So less reliance on purely seasonal pushes.
Seems like it. And despite a slow start to swim season, apparently momentum built later on. Both swim and outerwear were top 5 items over Labor Day weekend.
Labor Day, that's usually discount time.
Right. But they noted these were sold at relatively full price. The CEO said he hadn't seen that happen before in his time there. That suggests the product is resonating.
Who are they targeting with these products now? Has the customer focus shifted?
They are aggressively targeting the 35 to 50-year-old evolver customer. That's their term.
Evolver.
Yeah, someone who tends to buy across multiple product categories and has a larger basket size. Basically, a more engaged, higher value shopper.
And how are they reaching them?
This is supported by some pretty sophisticated AI-driven personalization. Things like tailored product display pages for different channels. So what you see on Amazon might differ from Nordstrom or their own site.
Personalized storefronts, almost.
Kind of. And segmented catalog strategies, too. Even their traditional Resolver customer might get a different catalog, maybe featuring WASIS pricing, which they said the Evolver doesn't really respond to.
That's a really granular level of customer understanding they're aiming for. Okay, what about internationally? You hear so many retailers struggling, especially in Europe. How's Land's End doing there?
Yeah, Europe's definitely still a challenge. They saw a 15% year-over-year revenue decrease there.
Ouch. Why?
Primarily due to macroeconomic pressures, inflation, cost of living, all that, and some ongoing supply chain issues specific to the region.
So headwinds are real there. Any bright spots?
Well, the company is encouraged by early progress from new channel additions. Remember the distributed commerce model?
Right, applying it in Europe too.
Exactly. They've opened on Amazon, Next, and Debenhams marketplaces there, and they said those are actually exceeding initial expectations.
Okay, so the strategy might work there too.
That's the hope. They've also launched a French language website, trying to limit discounting there, and are elevating the look and feel of their German and UK sites, adapting the US playbook. They see Europe as important for the brand's global image too, not just sales.
So we've seen how they're strategically trying to transform the business, a lot of moving parts. But for investors, the big question is always, how does this translate into the numbers going forward? What's the official outlook, especially with this updated guidance?
Right, the proof is in the pudding, as they say. Management did provide specific figures that suggest they expect things to get better.
Let's hear them. What's the third quarter outlook?
For Q3, they anticipate net revenue between $320 million and $350 million.
Okay, that would be up sequentially from Q2's $294 million.
Correct.
Yeah.
And they see mid to high single-digit GMV growth. That's gross merchandise volume across all channels.
And the bottom line for Q3?
They project adjusted net income of $3 million to $7 million. That translates to adjusted diluted EPS of 10 cents to 22 cents.
So back in the black on an adjusted basis?
Exactly. And adjusted EBITDA in the range of $24 million to $28 million. A definite projected improvement from Q2.
Okay, that Q3 forecast sounds more positive. What about the full year 2025 outlook? Did they update that?
They did. Land's End updated its full year guidance. They now expect net revenue between $1.33 billion and $1.4 billion.
How does that compare to previous expectations? It feels like they might have trimmed the top end a bit, given the Q2 miss.
That's often the case after a miss, yeah. They're projecting low to mid single-digit GMV growth for the full year.
Okay. And profitability for the year.
Adjusted net income is projected at $19 million to $27 million, with adjusted diluted EPS at 62 cents to 88 cents,
Right.
and adjusted EBITDA between $98 million and $107 million. Capital expenditures are forecasted at approximately $25 million. So the guidance still implies decent profitability for the year, likely driven by those margin and cost efforts.
And we can't ignore the elephant in the room, the strategic alternatives review. What's the latest on that? Is a sale still possible?
That remains a significant wild card, absolutely. The board's previously announced review looking at everything up to a potential sale or merger is still officially ongoing.
Did management give any hints?
Nope. They explicitly stated they would not comment further at this time. Standard procedure during such a review.
But there were those reports earlier.
Correct. Previous reports, I think Reuters back in July, indicated bids from Authentic Brands Group and WHP Global were potentially in the mix. But again, no official update from the company itself. It just hangs out there as a possibility.
Okay, putting it all together, it's easy to get, drawn into these operational improvements, and the strategic story management is telling.
Yeah, they paint a compelling picture of transformation.
But the market's initial reaction was still pretty negative on that revenue miss. How do we square that? Are investors right to be cautious, or are they missing the bigger picture here?
That's really the crux of it, isn't it? This quarter truly highlights a trade-off. Land's End absolutely demonstrated strong execution on profitability levers, expanding gross margins, cutting SG&A costs significantly, even while that top-line revenue declined.
So, managing the bottom line well, but struggling with sales growth right now.
Exactly. And the market's cautious reaction suggests a heavy focus on that immediate sales shortfall and maybe concerns about near-term growth visibility, perhaps overshadowing the strategic progress and the, frankly, impressive work on costs and margins.
It's a classic short-term versus long-term view dilemma.
Precisely. The market seems to be weighing that current pain more heavily than the potential long-term gain from the strategic repositioning.
How does Land's End fit into the broader retail context right now? Is everyone struggling, or is this specific to them?
It's a bit mixed. In the broader context, Land's End operates within a, let's say, choppy discretionary retail environment.
Meaning?
Well, the overall retail sector, if you look at something like the XRT Retail ETF, that's actually been showing some strength, trading near 52-week highs around the time of this call.
So general retail isn't doing too badly.
Overall, it seems resilient. But Land's End specifically faces pressure from softer demand in certain categories. Maybe apparel is tougher than other retail segments, and those ongoing challenges in Europe we discussed. So there's a bit of a disconnect.
Okay, so it's not just the tide lowering all boats. There are specific factors for Land's End. For investors watching Land's End closely then, what are the key things to look out for? What could really move the needle in the coming months?
A few key catalysts come to mind. First, their ability to actually deliver on that Q3 guidance they just issued. Meeting or beating those numbers would be a big confidence booster.
Sure, execution is key.
Second, performance during the upcoming holiday selling season. That's absolutely critical for any apparel retailer. A strong holiday could change the narrative quickly.
Makes sense. And the third?
And third, of course, any updates regarding that strategic alternatives review. An announcement there, deal or no deal, would likely have a major impact.
Right.
Looking longer term, the narrative really hinges on whether this pivot to a asset-lighter, distributed commerce model can truly translate all that cost control and channel realignment into sustainable, durable growth.
And whether that strategic review potentially accelerates things.
Exactly. It's a company clearly in transformation mode, and these next few quarters will be really telling.
All right, that brings us, as always, to our This Is Not Financial Advice segment. What wild but maybe plausible idea have you cooked up this time?
Okay, deep breath. Remember, absolutely not advice, but given the cautious market reaction, the market seemingly overlooking some solid operational gains, the margin expansion, the path back to profit in the guidance, and that strategic review overhang.
Yes.
Here's a thought. Maybe consider a short-term long position on Land's End stock. Maybe combined with a long strangle option strategy using out-of-the-money calls and puts for the next, say, 2 quarters.
Whoa, okay, unpack that. Long stock, A&D, a strangle. Why both?
The rationale is sort of twofold. First, the long stock position is a bet that the market is overlooking the operational floor here. The cost cuts, the B2B strength, the improving margins, the potential for a Q3 beat based on guidance, and those Labor Day comments.
Okay, a bet on fundamentals stabilizing or improving.
But then you add the long strangle buying both an out-of-the-money call and an out-of-the-money put.
Hedging for volatility.
Exactly. It hedges against the huge uncertainty from that strategic review. If a favorable M&A deal or some other major positive strategic announcement happens, the calls could offer substantial upside, potentially more than offsetting the premium paid.
And if the review falls through or there's bad news?
If the strategic review disappoints, or maybe Q3 misses badly, or Europe gets worse, then the puts could provide downside protection and maybe even profit from a sharp drop.
So you're trying to capture potential upside from either operational improvement or a big strategic event while cushioning against a potential sharp negative move.
That's the idea. It aims to play both the potential event-driven catalyst, the strategic review, and the possibility of short-term operational stabilization or outperformance, while acknowledging the significant risks involved. High risk, potential high reward, or protection. Again, purely conceptual.
Definitely conceptual. Okay, to wrap this up then. Land's End's Q2 saw that revenue miss and wider loss, sparking some market caution. But as we dug into, we also heard about really significant progress in margin management, that strategic pivot to distributed commerce, showing some early wins and impressive strength in their B2B segment.
Yeah, a lot going on under the surface. And that board's review of strategic alternatives continues to be a really important overhang and, a potential catalyst either way.
So while the market reacted cautiously, maybe focusing on the immediate top line.
Exactly. The underlying narrative is one of a company actively trying to transform its business model. And they're demonstrating pretty credible execution on profitability, even in what's still a challenging retail environment. They seem to be playing a longer game here.
Building a more resilient, maybe more agile business for the future.
That certainly seems to be the goal.
And remember, everyone, that trade idea we just discussed is purely for entertainment and conceptual discussion. This is absolutely not financial advice. Please do your own research.
Absolutely. But we do encourage you to dig into these insights. Think about how Land's End's balancing act, that pressure on the top line versus the gains in profitability, might reflect broader trends you're seeing elsewhere in discretionary retail.
It really raises that interesting question. How much should investors prioritize those immediate short-term revenue numbers versus perhaps longer-term strategic operational shifts?
It's a question worth considering for many companies right now.
Indeed. We always appreciate your insights, so feel free to share your thoughts on today's deep dive into Land's End. Thanks for tuning in to Talk Tickers.